The mid and small cap indices both did better than the large caps yesterday. So 0.5% of the small cap index and the mid cap index is also up about 0.25% or so. So it's a quieter start. Yesterday was quiet all told, and I think today, this morning at least, something similar. 30 points now on the Nifty, 0.12. That's a Nifty heat map. Bulk of the Nifty 50 names are all starting in the green. Asian Paints for the second day running, I think, is down in terms of down the most on the Nifty index. Adani Enterprises on the other end, Bajaj Finserv, etc. as well. Surabhi.
Okay, very, very quiet. Adani Enterprises is in news. It's received a sizable order, over 4,000 crores, for setting up a ropeway project in, I think, at Kedarnath and Sonprayag. That stock's up about 1%. M&M, Hero, some of the auto names are coming back. They took a couple of days of a breather. Right now, there's buying of about 1% on Mahindra & Mahindra, and Hero is up a little over 0.5%. L&T, 0.5% higher. There is Adani Ports, which is managing to flash a little bit of green as well. NTPC and Power Grid from the PSU power space looking okay, but then it just completely quietens down. On the lower side, you've got a couple of large names like HDFC Bank and ICICI Bank, flat to negative. Lever is at the flat line. Asian Paints, Titan, Nestle. So it's a bit of a down day for a lot of consumer stocks. Eternal also lower by about 0.2% at this point in time. Nothing is falling too much. Nothing is rising too much. So it's that kind of a market. Nifty is very, very flat at this point, 22 higher.
Well, mid-cap index absolutely unchanged. The big winners are some of the ones with order wins. So Sangvi movers 3.5%. NCC starts off trade with a gain of 3%. Mishra Dhatu higher. Transrail Lighting 2 has a green tick at open. KRBL rebounds after the 10% gash yesterday. United Breweries in focus. There is a JP Morgan note, overweight. They say the stock has corrected 10% in the past 2 months while the Nifty has been flat, and it offers a good entry opportunity. So they've got a target price of 2,050 on United Breweries, and that stock opens up in the green. Other movers include, I think there is a company called Sigachi that's higher. GMR Power up for the second day in a row. Yesterday, stock was up nearly about 10-odd%. It's followed it up with another 3.5% gain, 22% rally from the start of this month. So GMR Power continues to be in focus. Anantraj sees buying. Yet again, that's the data center play that the street's excited about. One Mobi quick on, should be on your radar for the kind of volumes and price action it's seen. And today, that stock is up 2%. On the way down, railways are seeing some profit booking after yesterday's run. IRDA, Aircon, RVNL have opened in the red. Apollo Microsystems too. Stock which has seen a 180% surge this year is now down close to about 1.25%. And Asahi India QIP has been launched and the stock has opened. They're planning to raise about 1,000 crore rupees. Let me rephrase that. And the stock is down close to about 0.5%. Very, very quiet opening, unchanged.
Yeah, no, absolutely. And so far, nothing on it. So 25,090 on the Nifty and 81,870 on the Sensex is where we are at. Those are changes. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Thanks very much for your time. From the last time we spoke, and I think the market's it's moved from one end to the, it's not a very large trading band, but from the lower end, we've kind of moved to the upper end. Does the band still hold, and will we kind of continue to move within this up and down a little bit? But single stocks, of course, we've seen very large moves in 2025 as well, even as the Nifty is only up about 1% YTD. What are your thoughts, Ashwini?
Morning, Prashant. Good to see you again. My sense, as I said, last time when we met, is that we are stuck in a narrow band. We need some time correction because valuations are expensive. And on an aggregate basis, Nifty doesn't really have a lot of room to move beyond this 24,000 to 26,000 range. I continue to be in that frame of mind, but I'll make two corrections. One is, I think the government's response to the higher tariffs from the US by way of cuts in GST rates and rationalizing of the GST rate table is actually a very big positive. And I am hoping to see a significant revival in demand as the year progresses. Addition to that is that liquidity conditions are reasonably benign, and especially in the microfinance area and unsecured credit, where there were significant brakes applied in the calendar 24. you should start to see more easing up of credit. So, you take the two together, and I think second half of financial 26 might see some revival in consumer demand. And that, to me, is actually a positive on the overlay that we had spoken about the last time. Coupled with that, we have the U.S. trade representative in India today. There are hopes that India will revert to a lower tariff of about 20 to 25%, as opposed to 50% that's being levied right now with the U.S. As the year progresses. And if that happens, that will give the market another leg up. The question that I'm struggling with is that we are seeing a huge amount of paper supply via IPOs, offer for sales, and promoter sell downs. And there are no foreign flows at all. So the domestic market, which is reasonably price agnostic in its approach, is absorbing all the paper. Can this last, and how long can this last? That's the question that I'm thinking about.
It's a very valid question. We all wonder, Ashwini, but I guess it lasts till retail investors give mutual funds 30,000 crores every month. That's just in SIPs. The overall numbers have been even better, between 35 and 40,000 crores. So let's see, and fingers crossed on that. But, while we are obviously talking about the market being very sideways, I was looking at some large cap names. Forget mid caps and small caps. I mean, Maruti is up 40% this calendar year. So who is to say that we are in a sideways market, right? And even the other one, look at Eicher. Eicher's up 42%. And these are large cap names. So let me start right there with the change, the pivot that the market has made on some of these beaten down auto names. Do you think they've run their course, and a lot of the excitement and the GST cuts, the festive turnaround, is that already in the price, or are they good for more?
Survi, great question. I think, just stepping back a little bit, I think these opportunities on a bottom-up basis among the large caps and more so in the mid and small cap space will continue. I mean, there are pockets of the market where you'll see exuberance and pockets of the market where you see complete despondence. And in a sideways market, that's the play. That you move from areas of exuberance to areas of underperformance, and that's where some bottom-up money can be made. The auto stocks have obviously run up significantly. Valuations are now looking punchy to me, but who knows? If the car sales numbers and two-wheeler sales numbers pick up meaningfully once the lower GST duty kicks in on 22nd of September. Then the momentum can take these stocks further. That's very difficult to determine. But on valuations basis, there is not much room. There is my personal opinion. I see opportunity in banking names. I'd mentioned in my opening remarks that easier liquidity and growth are both looking positive. So I think the entire banking and finance space, especially the NBFCs and more so the microfinance space, is one area where I see some rich pickings. I also see an opportunity to buy some of the beaten down exporters because I do think that a thaw in the US-India conversation gives me hope that lower duties will be put into place, maybe not immediately, maybe in a few months' time. And that, I think, is another opportunity. And likewise, there are several bottom-up opportunities, both in the large cap and in the mid and small cap area, which offer attractive pickings in a market which moves sideways and goes nowhere. As I'd mentioned to Prashant, I think in my previous conversation, if you go back and look at the market from 1993 to 2003, the index really went nowhere. And yet there were plenty of stocks where you made a lot of money if you chose to back the right names. And I think it's that going to be all over again. 93
to 2003, Ashwini, you're scaring us. Now, we hope it's not a lost decade, I mean, at an index level. But yeah, take your larger point that till the index starts moving and galloping ahead, we need to keep the head down and look for specific stock opportunities. But yeah, imagine that. One whole decade of sideways markets.
But Ashwini, it's already been about 13 months since we hit our all-time high levels last year. So to your mind, if you have to make an assessment, how long will this phase of consolidation continue at the headline level?
Okay, so like Suruchi said, even I hope it's not going to be a decade, maybe a couple of years. But I think, you need to see the valuation, see a little bit of time correction. I mean, I think while valuations in India for the Nifty 50 are, not at their peak and they are more or less in line with 5-year averages and probably slightly above their longer term averages, I think the problem is growth needs to pick up. I think I find it particularly hard to explain as to why 21 or 22 times earnings is reasonable for an environment where earnings are growing at 10 or 11%. We need earnings to bump up to at least 15, 16% for valuations to sustain. And if they don't, then I think you need another year and a half of the Nifty going nowhere for the valuations to come to maybe around 18 and a half times earnings where they start to look reasonable. Now, that's just arithmetic is what I'm proposing to you. But what can happen is that if consumption demand rebounds in a big way, and if the government pushes ahead with more reform, including some privatization, and that brings back foreign direct investment and foreign portfolio investment, then all bets are off. Then you could look at a much higher Nifty in even a shorter period of time. So what I'm trying to say is that, I'm not that negative. I think on the balance, I'm a bit more positively biased.
That's good to know. But on this point of growth, Ashwini, I'm glad you raised it because I was looking at some data from the NSE just yesterday. It's hindsight data, but sometimes the numbers just hit you so hard, right? So for the Nifty 500 universe, at the end of the first quarter, the top line growth is about 5.9%.
That's right.
The PAT growth is about 13.2%. And we know this has been the trend, right? I mean, when your top line growth is anemic, it's in single digits, margins have swollen, PAT is better. And I was having this debate earlier with my co-host yesterday itself that we love to put the ball in the RBI's court or in the government's court, but at a philosophical level, I mean, doesn't something need to change with India Inc. as well? Because growth is simply not coming by. And what happened? 1.4 billion consuming people. How is it that we're growing? I mean, companies are growing at an aggregate level of 6-7%.
No, I think it's a combination of demand being subdued because of lack of credit availability and over leverage at the household sector. I think that's what has hit demand. And I think at a macro level, my personal feeling is that tariffs in India are very high. And that protects the domestic industry to a point that we don't bring prices down. We don't offer the consumer the surplus that he needs to be able to consume more. I really hope that the government starts looking at tariffs on a serious basis and figure out where we need them and where we don't. I think the reason why India lags the global case studies like Japan or Korea or Taiwan or even China is that we protected the industry far too long, and that hasn't allowed us to build the competitive intensity that we needed to scale up. Guess where I think the industry competes the best? It's IT services, it's financial services, and there is no protection. I mean, in the sense that you compete with the best in the world to win the business that you do. But in manufacturing, I think significant amount of tariff controls need to be taken down. That's my belief. So let me put it out there.
Yeah. The earlier point about, I think, the credit, I think credit is put differently. The financial institutions are not stressed, but maybe their borrowers are a little stressed, right? Ashwini, and that's sometimes what we hear. You are intimately familiar with the textiles business, and I think you sit on the boards of one of them. And with what's happening now, Ashwini, and this was a segment which was hard hit because against expectations, things went completely south. But hopefully it'll get resolved. Do you think these are good levels to look at some of these businesses?
I mean, stock-wise, I don't want to make any comments, but I think generally speaking, I have this investment belief that, whenever there is a cloud over a certain company or a certain sector, and, if you can build a thesis around why that cloud will lift, that's usually a good investment opportunity. Now, obviously the market expectations around tariffs have also evolved over the last week or 10 days, ever since, those comments between President Trump and Prime Minister Modi were exchanged. and some of the stocks have reacted. So one has to look at valuations and take a call. But I do think that the pessimism will probably fade as we go along. I'll leave it at that.
Yeah. So I think that answer is clear, but you've got to build the case, right? It'll get solved and it'll get resolved. And it has to, I mean, at a broader level, can't be 50. But does 25, a base of 25 make sense? And are these competitive at that rate? And so that's another question. But business by business in that sense. Just a couple of other names I want to highlight before we go any further. There's Sri Pushpak, which is taking off vertically, right? So day before yesterday, Friday's close was 330. Stock's at about 430 now. It'll come up on your screens. So it's it doesn't come up in the top volume-led gainers list, but it is. That is Sri Pushpak. It's the third largest volume-led gainer on the NSE across the board. Number 2 is Sigachi. Number 1 is Anantraj. But those are much smaller price gains, 2% and 3% gains. NTPC Green is another one, which is coming up with about a 3.33% gain. So it was not there when we started, but now in the mix. Reddington is up about 5% or so. And GMR Power, we discussed earlier, 2% on GMR Power after yesterday's sharp move in the green. Indocount is coming up with about, that's a textile name, 9% on Indocount, 305. KPR Mills is up about 6.5%. We were talking about this pack with Ashwini on the textiles front. So you got two of these names with some of the largest volumes right now and decent price gains as well. What else? I mean, JK Cement, there's Walkhard, Medanta is up about 3%. These are all Cross, that is KROSS, which is up about 4% or so. So, enough and more names which are starting the day in the positive. 4:1 is the advances to decline ratio at this point. By the way, the largest loser is the largest volume-led decline is BSE. BSE is down about 1.6%, 1.7%. So about almost a million shares, nearing a million shares in terms of volumes. And the other one is Ixigo. I highlighted this around the same time yesterday as well as a very large volume-led loser. It ended down about 6%. It's down another 6%, Ixigo. But, context is important. Even with the 12% knock last 2 days, stock's up 60% YTD. So high this year is 330. It's down to about 270 odd rupees or so as we look at things. Ashwini, and these travel names, any thoughts? Ixigo, of course, is the newer lot, but there are so many others, right? As a theme?
I think travel, entertainment related consumption will continue to do extremely well in India. I mean, I think hotel companies, hotel rates are crazy. I was going to be in Bangalore and looking at hotels, and there's nothing available for less than 35,000 rupees a night. Similarly, in Delhi, any decent accommodation, is 25,000 rupees plus. So I think hotel stocks, generally speaking, will continue to do well, and so will travel and the airline duopoly story. Of course, we all know. So I think travel-related consumption will continue to do well. I think there are stocks out there which will look very interesting to me. Unfortunately, you can't discuss names, but yes, that's a place I'm looking at.
Okay, all right. So travel, tourism, some exporters. So we've got some clues, some ideas there. Thank you so much, Ashwini, for joining in. Good conversation, and we look forward to the next one. Well, with that quick eye back on the screen, and actually it's picked up. So the morning lull has been bought into, which is what's been happening with the market, and that's the good news. I mean, the dips are getting bought, and now it's a 60-point move on the Nifty, so not bad at all. Let's also bring Vivek back in because a couple of these companies that secured order wins, those stocks are higher, and NCC is definitely one of them because NCC announced pretty large order wins. I think over 2,000 crores, right, Vivek?
Absolutely right. So NCC, what's actually happened is that as far as the water segment is concerned, that is why yesterday they received an order. The order value is over 2,090 crores. So who did they get the order from? It's from the Bihar government itself. And this particular order involves various EPC civil construction works for Barner Reservoir Scheme. The total construction period is just around 30 months. So 2.5 years is when the the company should be able to fully go ahead and recognize the revenue. What we need to keep in mind is that the Q1 FY26 order inflow was just around 3,660 crores. So this particular order is almost 50% of the order inflow that the company received in Q1. Consolidated order book right now very strong at over 70,000 crores at the end of Q1. NCC, on the back of very strong order wins, is in focus today.
Okay. All right. Got it. Thanks very much, Vivek, for that. Let's move on now and look at the next corporate discussion that we have for you. NLC India has signed an MOU with Kabil to collaborate in critical and strategic mineral projects worldwide. Mr. Prasanna Kumar Motupalli, Chairman and Managing Director at NLC India, is with us. And of course, we want to discuss three key points: the rare earth opportunity for the company, how this collaboration with Kabil will work. And of course, we want to understand the updates on the commissioning of certain key projects as well, and the status of the company's upcoming IPO of the renewables business. Mr. Motupalli, thank you very much for being with us. So let's start with rare earths first. Tell us more about this association that you've done with Kabil, because in the past as well, you've said that you will be looking at rare earth blocks, perhaps sourcing them from African countries like Congo. There is also, I think, an alliance or a tie-up with the Bhabha Atomic Research Center to look at what you can do with fly ash. So tell us exactly where you are and how will this particular alliance with Kabil work?
Madam, as you know, NLC India is having experience of more than 7 decades in open cast mining. And to leverage that experience and seeing the potential of critical minerals and rare earth elements going forward, for the energy transition as well as the renewable integration. Since beginning, we have been participating in the auction process of different branches of the government. And in the last auction, we got 2 critical mineral blocks in the state of Chhattisgarh. They are of phosphorate and limestone, and the activities are in fast progress. Similarly, we want to seeing the potential of critical minerals and rare earth elements. We are exploring the possibilities of having the mines abroad, and in this process, we entered an agreement with Kabil and as well as IREL to explore the possibilities in different countries. So, as you rightly said, we explored the possibilities in Congo and other places also, and Mali also, and things are in fast progress.
But sir, we'll need some more specifics if possible. So, when you say explore possibilities, basically this, this I think it's JV, right? So, Kabil and you together will go and look at bidding for mines, is it? So, how much? Yeah. So, how much money has been put aside for this? Have you already identified assets? I mean, how close are you for the first asset to come into your fold?
Madam, actually, we have not exactly identified some amount for this. For all the green initiatives and renewables together, we are planning a capex of around 60,000 crores in the till 2030. And whenever opportunity comes, we are ready to take up the opportunity and take it forward.
So this investment with Kabil is a part of the 60,000 crore capex, or it will be over and above?
Actually, it is over and above that 60,000. It's RE and green initiatives is 60,000, and over and above that, it is whatever we invest in other countries.
You know, sir, I read in a report that you are looking at producing 1 million tons of critical elements. Now, I don't know if all of this is rare earth or, generally critical elements over the next 5 years. Is this a correct estimate? And also give us some revenue. Yes, sorry, go on.
As per our corporate plan, we are targeting 1 million metric ton of critical mineral ore by 2030. That is in that direction, we got 2 critical mineral blocks in the state of Chhattisgarh for phosphorate and
sir, the revenue. Okay, got it, sir. Got it. So this is your declared intent. What is the revenue that you will perhaps make either this year or next year And what is the revenue implication? Over 5 years, how much revenue will get from the sale of rare earths?
Madam, it is just we started taking the mine and starting the exploration activities. So at this point, immediately we will not be getting any revenue out of it. And by 2030, by sale of this 1 million metric ton critical mineral ore, the revenue will start at that point of time. Not immediately any revenue will come from this source.
Okay. What kind of JV will this be? 50-50? Have you worked out how will the revenue be shared, the investments be shared?
All those details are yet to be worked out, madam. It is just we signed an MOU with the Kabil for taking this activity forward.
Okay, and sir, what's the final question on this, and then we'll move on to your other projects. What is the timeline? By when are you, can you give us a timeline? By when do these rare earths come into India?
So that's what I told, madam. This target is 2030. Before that, I think we want to complete that project.
Okay, okay.
Sir, just getting back to business then, your Ghatampur Unit 2 was expected to be commissioned by September end. Is that on track? Also, if you could update us on Unit 3.
Madam, the Ghatampur Unit number 2, already the oil synchronization is done. We are in the fast progress for commercial operation. There may be a delay of a week or two. Otherwise, the project is on track. And the unit number 3, we are targeting the commercial operation by December end, and we are on track in that also.
Got that. And the Talabira power plant commissioning timelines?
Talabira power plant, we are going for 3 into 800 megawatt. Already order is placed on BHEL, and the mobilization started at Talabira. And the first unit will come after 52 months in the financial year 29-30.
Okay. Got that point, sir. Finally, just tell us about the timelines for the renewables IPO, the process, and how that's moving along.
Regarding this renewable IPO, the transfer of the assets from NLCA to NIRL, the tax exemption we already got from the government. And we are taking this activity fast forward. Recently, we got cabinet approval for this 7,000 crores transfer also. So we are taking it in fast forward mode, and we are expecting by the second quarter of the next financial year, the IPO will be coming.
Okay, so Q2 of FY27, we should have that. One final point, the capex outlay that you have shared with investors is, I think, 1.16 lakh crores. That's over a long period, 5-year period till FY30. What is the capex looking like for this year?
This year, the capex will be around 9,000 crores, 9,000 to 10,000 crores. And from next year onwards, it will be around 15,000 crores, and subsequently it is 25,000 crores. Once our Talabira Thermal and our Neyveli 2 into 500 megawatt, they start activities, then our capex will further improve.
Okay. All right, Mr. Motpalli, we'll leave it on that note. Thank you very much for joining in and giving us a lot of those details. That's NLC India, looking at more alliances, looking at global sourcing of rare earths, including, of course, more sourcing from the African continent as well. Well, with that, quick check on the markets before we move on. Still up about 0.25% on the Nifty. Mid-cap index is also higher by about 0.2%. And the advance decline ratio is very positive, actually. That's the best part about trade this morning. You've got almost 2,000 stocks advancing on the NSE and less than 600 declining stocks. So it's not bad at all. Indices are quiet, but beneath the surface, stocks are going ahead and doing their own thing. I think we do have to take a very quick break on that note. Let's do that. Take that break, come back on the other side. And when we come back, we'll get you an exclusive conversation with the management of United Spirits on how they're looking at the rest of this year.
Welcome back. After a flat start, things have picked up a bit, and now the Nifty is hitting yesterday and day before's intraday high. We're currently at 24,134. The intraday high yesterday was 25,138. The day prior, that's last Friday, 25,139. So that's been a bit of a hurdle. Even the swing high in August was about 25,150. So now approaching a bit of a resistance. Let's see whether we can conquer that. Banks are pushing up today. So the Nifty Banking Index is up close to about 100 odd points. Axis Bank, Kotak Mahindra Bank seeing some buying interest. Though on the flip side, HDFC Bank is not doing anything. But let's get to our consumption centimeter segment. We're focusing on United Spirits and the demand trends in the alcohol beverage industry. Mangalam caught up with Praveen Someshwar, MD and CEO of the company, and began by asking him about his strategy under his leadership and the immediate targets for the future. Listen in.
The way I look at it is, look, there are three key pillars as you build out businesses. And if I were to look at Diageo India, equally exciting. One is, how do you future shape our portfolio so that we can win come what may given with the consumer? That's number one. Number two is, how do you embed Diageo in society and therefore win with society at large versus winning only as Diageo? And three, how do you create an organization of the future and constantly look at it? India will be the consumer market of the next decade, as I see it, okay? It's got its ducks in a row. In spite of everything going around the world, look at the demographic of the country. Look at how the middle is growing. Look at GDP growth. And that's a great place to be running a business. That's my first. Second, look at Diageo's portfolio within the country. Powerful portfolio, 3,000 crore brands, 500 crore brands, 400 crore brands. Wow, 7 1 million case brands. This is of scale. And finally, is about innovation. Okay, how we are embedding innovation within the organization. You can see us investing in our R&D, investing in talent around it. So it gives me, a clear, opportunity for us to unlock the future portfolio.
5 years from now, you're saying double-digit growth that comes by. I suppose 64 million cases is what you did last year. If you go double-digit over the next 5 years, you're not too far away from over 100 million cases. Would that be a goal? And your margins, obviously you spoke about high teens having been achieved. Large part of that is also capped because of the 10% BIO margins. So I suppose around high teens, maybe touching 20, 21%. Would that be a goal for you?
The way I'd look at it is, I think premiumization is real in India.
So then do you look at volume growth or do you look at revenue growth?
I constantly look at value, because the way I look at it is consumer in occasions. How do I get a share of the occasion? And how do you grow that share of that occasion? And that occasion share, I would love to see volumes and therefore consistently grow. But more importantly, how do I keep premiumizing and look at value? So I would look at value growth constantly. That's been my yardstick in whichever business I have been.
Got that.
So I am looking at double-digit revenue growth, absolutely. And yes, as we grow margins ahead of revenue, you will see that inching upwards. I'm not going to say is 20 good or 21 good or 19 good, but what I'm very, very clear is double-digit revenue growth in our P&A segment so that we are consistently winning and our margins improving further than that. And that's going to become, we are already roughly $1.5 billion in terms of revenue at a double-digit growth CAGR in 5 years. That's an exciting proposition.
There could be some speed bumps along the way. The speed bumps would obviously be from the regulatory environment. And let's go state by state, and let's do this as rapid fire as we can. Maharashtra, 30 to 40% price increases. How do you deal with something like that? And what's your plan here?
India is 25 different markets. In each of these states, the framework is a little different. And we've seen over a 3 to 5 year cycle, each of the state goes through some exciting tailwinds and some headwinds. Right now, yes, Maharashtra, we've seen some regulatory action, which has resulted in roughly a 30 to 35% increase in price. Our duties have gone from 300% to 450%. But look, this is reality. It's been roughly to today, what was the date? Yeah, roughly around 70 days from the new regulation. And we've seen 40 days of the new pricing in the marketplace. We've seen consumer spend grow by mid-teens to high teens. What it tells you is that, look, we took a 30 to 35% increase. Our brands are strong enough for consumers to start up pricing and up paying up. To be revenue neutral or volume neutral, you need to grow consumer spend by 30 to 35%. We're still some distance away. But in the normal course, mid-teens to high teens is an exciting space. I would take that any day. So it tells me that, look, in terms of we seeing growth, we're not seeing translation into volume growth as yet. But every day ahead, I see this improving. And I see in the next 6 months, people from Maharashtra wanting to start to trade up.
You know, it's become a de facto thing now post the recent successes in some of the state elections, populist policies, many schemes that give a lot of cash to the citizens of that state in particular, and then you fund that through taxation on alcohol. Do you think this trend is likely to sustain, and as a result of which alcohol becomes the whipping boy once again?
Look, alcohol bev business is such a fun business. It's indulgences. And if you look at a country like India, indulgences will always be seen with a certain lens. We need to appreciate that, okay? Once we appreciate that, you embrace it. Once you embrace it, you start, therefore, building a portfolio of products, and therefore, which unlock each of the occasions. I don't see it as a negative. I see it as reality of India, and therefore, I just work with that in mind.
I ask this from an investor's lens right now. If you're looking at the entire alco-bev sector, you had a couple of listings in the recent past, people who've raised money from the markets, etc. They've been showing good growth. There has been a big deal as well. Imperial Blue was bought over by Tilaknagar Industries. So obviously there is that tailwind coming in for that stock. If you look at some of the other wine players, they are looking at some of the assets which are there outside of wine in the brown space, which is 85% of the category. And then I look at Diageo. Yes, it's the market leader. Yes, it's got the largest share in that space. Yes, it's got the highest margins. But at the same time, it's also got the highest PE multiple. So for you to justify that PE multiple, you obviously have to grow faster than the market on that high base with margins which are already at higher than everyone else in the industry. How do you continue to hold that edge?
So, the way I look at it is, are you growing the category? Is the category in momentum? The great news is, yes, we are growing the category is in momentum. Within that, do you have the portfolio to unlock the category space? Yes, we do have the portfolio. Are we now getting higher share of the occasions where our consumers are? Yes, we are consistently starting to get higher shares of our. Are we innovating to build the portfolio of the future? Yes, we are. If each of these are in play, then the virtuous flywheel is in play. So we are in a good place. We feel absolutely excited, and we believe the double-digit growth, which we will see, keeps us ahead of the pack on a sustained basis. There will be quarters when someone else will grow faster or we may grow a little slower. But in a reasonable period of time, you will see that we are consistently delivering above market.
So consistency over excitement is what you would bet on?
Consistency is any day something I would sign up for.
Okay, well, that's the management of United Spirits in conversation with my colleague Mangalam Malu. Interesting one. Vinay Rajani is with us, Senior Technical and Derivative Analyst at HDFC Securities. Vinay, good to have you with us back in the program. 80 points. I mean, started slow, but it's built on gains now. 25, 150. What are trades? How would you trade the index and your stocks?
Yeah, so good morning and thanks for having me on the show. So definitely the trend has been bullish. The previous stop was placed at 25,154 and we are about to cross that level. So that is a very good sign. And yesterday, despite the market consolidation, we saw that mid cap and small cap stocks in performed very well. In fact, they given the advanced bullish signal, they surpassed the August high much in advance as compared to Nifty. And now we are witnessing that Nifty is about to cross that level. So gradually we are getting strength. Broader markets are participating. So definitely setup is quite good, and it looks like that Nifty is headed for the next target of 25,500. On the downside, there is a strong support at 24,900. So with that, stop loss traders can continue to hold on to their long positions, and expecting good rally in the market, and 25,500 is the immediate target. As far as stocks are concerned, from the NBFC space, I like a stock like Chola Finance. So Chola Finance has given a fresh breakout, and already we have seen outperformance from Bajaj Finance and Finserv. Now this NBFC space can do well. So Chola Finance around 1545, one can go long. 1520 should be the trading stop loss. On the upside, I'm expecting a target of 1590. The second pick I would take from the real estate space, Prestige Estate, one of the strong stock technically, and after long underperformance, real estate started doing well. So a bit of short covering is expected in some sectors which did not perform in this year. So one of the sector is real estate. So Prestige Estate around 1608, one can go long. 1575 should be the trading stop loss. On the upside, I'm expecting a target of 1665.
Okay, thank you very much for that. Redington is making a big move now. Stock is up nearly 9%. Throw in a couple of these textile names. You've got an Indocount, Trident. These stocks are coming in for some buying. And Apollo Microsystems, we've been discussing this every day. It opened flat, in fact, in the red, but now it's back in the green. 3.5% up on Apollo Microsystems, taking its month-to-date rally to nearly 35%. Some other movers include Shri Pushkar Chemicals that Prashant was earlier talking about. You've got JSW Energy, Tata Power too, seeing some interest right now. But let's talk about Bajaj Finserv. Ria is now joining in to tell us more.
Well, yes, Bajaj Finserv has been in focus today since its subsidiary Bajaj Allianz General Insurance has won a dispute against the Maharashtra government. The Bombay High Court has held that the demand by the Maharashtra government is unsustainable for rupees 374 crores in additional payout under the PM Fasal Bima Yojana. And the High Court has quashed and set aside these letters from the Maharashtra State Administration seeking a payment of these additional dues. And in fact, the High Court has also dismissed the bill by farmers supporting the Maharashtra government's orders for this additional payout of rupees 374 crores. So this is a positive for the stock, and the stock is also reacting positively, up almost 0.8% at the moment.
Okay, all right, Ria, got it. Thank you very much for that. Let's put the spotlight back again on the progress of the India-US trade talks. Remember, America's top trade negotiator, Brendan Lynch, has arrived in India, and we're expecting talks to take place today. We have our colleague Abhimanyu joining in with the latest. Abhimanyu, so this is just a one-day event. What are we expecting today?
Well, it's not exactly the sixth round of negotiations, which was earlier stated for the last week of August, and now it had been postponed, but there is no further word from both the sides on when the sixth round is going to be held. So this one-day visit, these talks for one day, of course, hold a lot of significance as far as fixing the timeline for any future negotiations is concerned. Now, both the sides earlier had indicated their intent to finalize the first tranche of a bilateral trade agreement by the fall of this year, that is by October or November of this year. So the sixth round of negotiations is yet to take place. The date is also yet to be decided, but in all likelihood, all the pending issues are going to be discussed today as far as the one-day talks are concerned. Also, the Ministry of External Affairs would also be involved as far as diplomatic issues are concerned, which are also possibly going to be discussed in today's visit. Apart from that, India is already in talks with several other geographies as far as expanding its trade footprint, expanding the footprint of its exports is concerned. So this visit gains significance in view of the U.S. tariffs, which have severely impacted several labor-intensive exports from India. So all eyes, of course, would be on what actually takes place, what transpires in this visit, what are the issues which are going to be discussed, and more importantly, how early both the sides are going to come back on the sixth round of negotiations. Even as negotiations are underway, virtual rounds were underway, so both the sides are looking to proceed as far as the sixth round of negotiations are concerned, as far as fixing the date of that is concerned first. This visit, of course, would finalize and speak about all the pending issues between both the sides, both on the trade as well as on the diplomatic front.
All right. Abhimanyu, thank you very much for that. That is the sort of one-day trade talks US delegation here in India for that. What we're going to do is take a break, but just leaving you with some sound bites out of the interview with Manish Chokani, Director, Enam Holdings. Just a spattering of views with what he thinks the final rates in terms of tariffs that the US imposes will settle at. Of course, a market view as well. Listen, and we'll see you after the quick break.
What's happened with US and India was a surprise to everyone, I think, including to the protagonists over here.
Yeah.
Something changed during Sindoor.
Yeah.
And then I'm guessing something's changed over the last 1 week again to bring things back to what looks like even keel. But yeah, I mean, if you zoom back in a larger context, India and US have been the two best performing markets in the world, the best democracies and the best sort of places for capitalism to thrive. Even if you get to the 15 which the allies have, which is Japan, Korea, UK, I don't think we get to 15. But if you're at 25 and you have some way around that, let's see, maybe we end up at 20. This market was being driven or is being driven really by price agnostic domestic flows. There are opportunities in the market, but overall it's a market which is very optimistic. Like I said, strategics are out. FDI investors are out, PE investors are out, a lot of Indian promoters have sold their stakes down. And the market's being held by price-agnostic retail flows. And if a mood changes a bit over there, and I hope it doesn't, then we are in then you have to wait for the next cycle where you have similar optimism, which may be 3 years, 4 years later.
Welcome back. Markets are now 100 points up on the Nifty. It started off quiet, but now it's picking up pace. Sensex up close to about 350 odd points. And you've got M&M, Axis Bank, Tata Motors, L&T. Lots of winners now in the frontline pack. So now things are up and away. 8 days of gains, 1 day of pause, and now markets are back to their winning ways. But let's talk commodities. Manisha is now joining in. Manisha.
Thank you for that. Well, I want to talk about metals really because almost across metals as a sector seems to be trading on a firmer note. And this is ahead of the US Fed meeting where the markets have basically factored in a 25 basis point rate cut from the US Fed. The two-day meeting starts today and the expectation is that those announcements, tone, language, commas, full stop, everything the street would be hinging on. So as of now, 25 basis point of a rate cut has been factored in. It also has to do with the dollar index, which has seen a constant decline. That one is trading below 98, near its two-month lows, and that has been supportive for all of these dollar-denominated commodities, especially gold and silver. Let's bring gold on your screen, and we have seen string of all-time highs, record highs being hit in case of gold in this year. It's trading at an all-time high at around $3690 an ounce, not too far away from $3700 an ounce. We have seen prices gain up by 40% in this year until now, and that is in dollar terms. Gold also has made an all-time high of 1,12,000 rupees per 10 grams for the Indian markets. Gold also is trading at all-time highs in Chinese yuan, Australian dollar, euro, various other currencies as well. So gold clearly has been the place to be in this year. The other one that comes in on your screen has been silver prices. 14-year highs, and it's up 48%, outperforming gold. And then you have platinum outperforming both gold and silver with nearly 55% of gains in this year. We are looking at yet another year of deficit when it comes to silver and platinum. So apart from a safe haven buying, it also has to do with the demand and supply mismatch that seems to be supporting silver and platinum there. The base metal prices also have seen good gains. Copper, for example, is trading at 2-month highs, aluminum trading at a 6-month highs, and we've seen week-on-week and a month-on-month gains continue in case of these prices there. Strong gains also have continued, by the way, for iron ore, for zinc prices, which are also trading at a 6-month highs, and zinc has seen a gain of around 6% in the previous month as well. So with these kind of gains, August, by the way, was strong. September has been on the positive side as well. And when you look at the outgoing markets there is an expectation that you could be looking at stronger gains continuing from here as well. The Chinese data has not been so strong, but when you look at the US and the European markets, we've seen some gains come in here. For today, it is going to be about US retail sales and industrial production data from the US markets that is due today. The street will also watch out for the Fed quarterly summary of economic projection that is going to be released today after the US Fed meeting begins. And then you have US-China president slated to talk perhaps on this Friday. Remember that meeting in Madrid is ongoing right now. And in the positive side is the India and US meeting that kickstarts in Delhi from today. That is as per reports. So plenty happening in the international markets there. And amidst all of that, gold and silver clearly safe haven buys.
Okay. All right. Manisha, thank you very much for that. Gold and silver continuing to sparkle bright. We'll take a break on that note, come back on the other side, and it'll be our special segment, Indianomics, coming up. Latha today discusses whether India should continue with the 4% inflation target or not. She'll have Sajid Chinoy and Niranjan Rajadhyaksha with her.
We've not met anybody for the past.
Welcome to this very special Indianomics. Reserve Bank's flexible inflation targeting rule requires that every 5 years, the government shall, in consultation with the Reserve Bank, set the inflation target for the Monetary Policy Committee. The target of 4% CPI plus or minus 2% was set back in 2016 for 5 years till 2021. In March 2021, the government reviewed and retained the same target, the same range from 2021 to 26. Now, ahead of the review in 2026, the second review, the Reserve Bank has released a discussion paper asking members of the public to discuss and give feedback on the following 4 questions. 1, whether the MPC should target headline or core inflation, that is inflation minus food and fuel. 2, whether the 4% CPI target continues to remain the right target or whether it should be changed. 3, should the range of plus or minus 2% be narrowed, widened or done away with? 4, should the inflation target be removed and only the range be retained? Those are the 4 questions, and joining me to review the performance of India's inflation targeting regime and to answer these 4 questions are Sajid Chinoy, Head of Asia Economic Research at JP Morgan, also one of the original members of the Urjit Patel Committee which recommended flexible inflation targeting. So more questions to him. And Niranjan Rajadhyaksha, the Executive Director of Artha Global, a think tank and research organization, and formerly Executive Editor of Mint newspaper. He's everyone's best consultant for economics. Niranjan, Sajid, thank you very much for joining me. Well, first up, let's assess. Is it a success? Last 10 years, after all, we did have 4-5 years during COVID. I think 4-5 quarters in COVID when we were above even 6%.
Right. So, Lata, we have 3 criteria, I think, that I use to judge how this is done. The first is, there are always going to be exogenous shocks. So looking at absolute levels of inflation can be misleading. Look at how India has performed compared to the rest of the world. And that inflation differential with the rest of the world has narrowed meaningfully over the last decade. So, A, we have relatively outperformed, number one. For me, perhaps the biggest test here is the whole idea of a nominal anchor, an inflation target, is to serve as a coordinating mechanism for the economy to anchor inflation expectations around the target. An easy way to test that is to say, does headline inflation converge to core or does core converge to headline? And what you see is before inflation targeting came into practice in India, the data reveals us clearly, core used to converge to headline. That's a fancy way of saying inflation expectations were not anchored. For the last decade, what do we see? After the FIT regime, headline inflation consistently converges to core once shocks dissipate. So that's another way of showing that the purpose of this, to anchor inflation expectations, has been achieved. You have less spillover of shocks to food and fuel spilling over into core inflation. And the last is just look at RBI's inflation expectations data. There are shocks that we've all been through this poly-crisis period, but expectations are more anchored. So by each of the 3 criteria, how we've done compared to the rest of the world, whether headline converges to core, and that's changed after inflation target came in, and how measured inflation expectations are, I think by all accounts, it's worked very well.
Okay, well, just for the data that RBI put in the discussion paper, average CPI since the 2016 adoption up till 21, up till the COVID actually, was 4.9%. And average CPI from 2013 to 16, that is the new CPI series, was 6.8. So, their data is that statistically, at least, it has worked. But the CEA had opposed it, saying that in the first 5 years, anyway, food inflation everywhere was benign. In the next 3-4 years, food inflation was high and we didn't control. So that there is a counter argument. But Niranjan, you want to add success or failure?
No, I usually end up agreeing with most of what Sajid says. So I completely agree with him, that...
the deviation from global...
I think that India is no longer an outlier. Say, 10 years ago, if you looked at the world, it was battling deflation. Our inflation was pushing near double digits. Then, if you forget, you may say that the advanced economies are a different dynamic. But if you look at China, if you look at even peer economies of Asia, India was like 3, 4, 5 percentage points higher than the average. So I agree with Sajid. And I think the more important point is what he just mentioned about the dynamics between core and inflation and headline inflation. That if headline inflation is eventually converging to core whenever there is a temporary differential, it means that in a way people trust. He said inflation expectations. I would say people trust the Reserve Bank of India to keep inflation on target or close to target. So, I agree with Sajid that it's done quite well. There are, there'll always be debates about how the mandate is interpreted, etc. But net, I think it's worked for us.
Yeah. No, I think the missing chair here is the CEA. If I can convince him, I should get him. But he has very good arguments why the the framework itself is not appropriate even for developed countries. But that is not the mandate given by RBI. RBI has accepted flexible inflation. They are only asking the members of the public to argue within that. Yeah. The target is not being questioned at all. I mean, the framework is not being questioned.
Yeah, and Lata, I think the issue is how do you interpret the target? So if you look at not the monetary, the Reserve Bank, the amended Reserve Bank Act, but even the monetary policy agreement, it's not that growth is completely out of the equation, So there is a trade-off which the RBI has to. But in normal times, inflation management should be the standard, the main focus. And secondly, RBI is a full-service central bank, so it has to, in some way intervene in the foreign exchange market. It has financial stability, financial development, tools. I think the key thing is you should ask yourself that the RBI or the MPC has control over the repo rate. How are interest rates going to be matched to the inflation rate? It doesn't mean that RBI should do nothing but inflation control.
Okay. No, that's a fair question. We'll just come to that in a bit. But let me take the first question that the Reserve Bank has put on our plate. Core or headline? Now, I think there is a very legit argument that food is not controllable by the Reserve Bank. And, I counted from August of 2023 to December of 2024, 18 months, inflation was well above 6. In fact, it was between 8 and 11%. Yeah. But it did impact core. And RBI could do precious little about it. The argument is that by looking at it, you kept the system tight. Is that therefore...
So it is true that the food,
should be
food inflation and fuel inflation is, they're more susceptible to exogenous shocks, whether it's climate shocks, international geopolitics, etc. So accepted. But eventually, if your about 50% of your basket is fuel and food, you really can't have an inflation targeting framework and say that I'm only going to target half the CPI. The second is revealed preference. When the Ujit Patel committee was discussing this, and I remember, Sajid and I had a chat about it way back then. I don't know if he remembers. Thailand was one of the only economies in Asia which actually was targeting core. Thailand...
Uganda is also.
Yes. So now in this RBI paper, I think only Uganda is the... So I think there is, there is some logic, even other central banks, if you see the record, they are looking at headline inflation as their main target.
Yes, 48 countries.
Because Lata, it comes down to ultimately how does the framework work? And a key part, as I said, is to serve as a coordinating mechanism. See, inflation is both a function of slack, but also expectations. Therefore, it becomes so self-fulfilling. And so if this is meant to be a coordinating mechanism, you can't have an inflation target for a central bank that is very divorced from the lived experience of individuals. If 40-45% of your consumption is going to be food, and hopefully that will come down over time, but if it's going to be 40% of food, and that's what impacts your inflation expectations, then you can't have a central bank that's looking at another measure independent of that. The other quick point to make is if you get sustained shocks to food, they may, in a tight labor market, translate into wages, right? So by ignoring the food part and only focusing on cost, sometimes it's too late. The genie has left the bottle by the time headline, the food shock goes into core.
Yeah, I still have sympathy for the idea that central banks can't control food. And also in those 18 months that I just spoke about, we did not see it come over. This feeling that, food is expensive and therefore I need higher wages was not the trend observed. So the charge that by looking at food, the Reserve Bank probably tends to keep the economy tight remains, and the counterfactual can never be proved. Would the economy have grown more if they had not kept it tight? We don't know.
That's when the the flexible inflation targeting matters. Why do you have a 200 basis point band around it? When we debated that 12 years ago, it was precisely because of this.
Okay.
That there are occasions in which there is a shock to food, which is 40%. And if core is much lower than that, the central bank has the latitude to keep inflation above. We saw that in the pandemic. In the pandemic, inflation was consistently above 4%, but the RBI did not respond to that given the contextual circumstances.
Fair point.
This goes back to the point I was trying to make, that a lot also then depends on how the RBI interprets its mandate, because there are sometimes very, very good reasons to look through temporary shocks to food, or, we've seen like vegetables often, spark off a bout of high inflation. So a lot depends on how the RBI interprets its mandate. I think there is enough, if there are no observable second-order effects, either in terms of firm markups or in terms of higher wage demands, which will then flow into a second round of price hikes, I think the central bank is within its mandate to look through a temporary period of high inflation.
Yes, and I think they've communicated it beautifully at the times when they looked through.
And we've been through 3 years of this in the pandemic. That's my point.
Just one more before I finish this, and I want to go to the point of whether it should be 4 or 5 or 3, whether it should change. That's the more important argument for me. Should they, should we tweak the sentence in some way to give importance to core? I mean, the target is still headline inflation at 5 or at 4 or whatever. But core gets an emphasis. Should we accept that governments can't control food? Is there a need to tweak?
See, there are different measures of inflation, right? So we have a WPI index, you have a CPI index, you have core inflation, you have a GDP deflator. Now, as and when, somebody says that you should look at GDP deflator, sometimes you say an average of WPI per CPI. The question is, how do economic agents, what do they respond to? What does the man on the street respond to? That person, he or she is not responding to your
WPI.
core inflation or your WPI or GDP deflator. This is for us to, discuss in television studios. But I think the average person, what hits the family budget is the entire headline, the entire CPI. And that can change behavior if it leads to unanchored inflation expectations.
10 seconds, Lata. If you burden the RBI, I think the first thing we agreed on, 10 years ago when we met, or 15 years ago, was the Tinbergen principle. Yeah. You must have as many instruments as you have objectives. If you were to have focus on headline, focus on core, focus on growth, you're diluting the whole idea of inflation target. If you give the RBI...
change the sentence at all.
It's going to get so muddled that nobody is going to know what the RBI is eventually after. Yeah. And I go back to the beginning. What is the purpose of this? This purpose is to anchor expectations. If you have so many objectives, no one knows what you're after, how can you anchor expectations around anything?
Yeah, actually, Mishkin, the economist, is quoted, and he's saying that central banks may emphasize headline as target, but be guided more by core while deciding.
That's in advanced economies where core is typically 70 to 80% of your basket.
And see, even the US Fed, they sometimes look at PF, private final consumption expenditure deflator. These are inputs into the decision-making process. The target is...
So don't explicitly change it, but it will...
So again, it depends on how you interpret your mandate.
Monetary policy is an art, not a science. And I think the framework is meant to provide this combination of stability...
We have to take the next question quickly. 5% or 4%. Should we stick with 4?
Yeah, so the way I look at it is this way. The 4% came out of very sophisticated statistical, including by the Urjit Patel committee, but even other economists, that this is the sort of inflation level which maximizes output on a sustained basis. Now, the way I look at it also is that 10 years ago, the advanced economies, they were targeting 2% inflation. Normally, because of what is called the Balassa-Samuelson effect, another 2% is added to an emerging market. So now so in a way, the anchor of that, is the 2% which the
developed economy.
And then you add 2%. So now, if you are saying that inflation has moved up over the past, especially now,
globally, yeah.
Is there a case to push it up to 5%? Maybe. But the reason I would still argue against it is that it opens a Pandora's box. Because once you start fidgeting with the inflation target, you can create confusion. So I personally feel that there could be a technical argument for a 5% inflation rate. But then you basically said every 5 years you will have something else, some different target. And when the idea is that over a medium term, you want to stabilize expectations. So I think that keeping this anchor makes sense.
Okay, but I've not completed this argument. I have to take a commercial break. We'll come back and continue this argument of whether inflation target should be changed from 4 to 5 or to something less. All those arguments coming. Bazaar viewers, you will get into Chartbusters after the break, but the entire show will be played after market hours.